break down the financial jargon being tossed around the street is Brian Sozzi, Chief Equity Strategist for NBG Productions and editor of the Decoding Wall Street Newsletter. Brian, good to see you.
Thanks for having me.
So we keep hearing about these so-called macro issues that are causing a lot of volatility in the markets. What is macro volatility?
Macro volatility, basically there is no trend when you're in the marketplace when you're hearing macro volatility. And it ties to economic data. You're not getting data that is coming in concise. You wake up one morning, XYZ data point says one thing. You wake up the next morning, it says something completely different. As a trader, you may want to see this because you can get opportunities to go short and long. But as an investor, as a long-term investor, you need trends in economic data. You do not want to see macro volatility at all whatsoever.
With a debt crisis in Europe threatening to dismantle the euro, there's a lot of talk about a European divorce.
Correct, and this one is something new on the scene. European divorce, it's a word that came out of nowhere. You thought it would have been used a couple of years ago with all this debt that came out of nowhere. But European divorce is when right now in Greece, they could possibly exit the euro. It's a divorce. Right now it's resigned to Greece, so I think that's good. But if you start hearing European divorce attached to an Italy and a Portugal and a Spain, then you're talking some negative consequences for more negative consequences for our domestic market.
Yeah, maybe Germany should have signed a prenup, huh? Speaking of indebted countries, we keep hearing about this notion of a fiscal cliff here domestically that could plunge our economy into recession. What exactly is the fiscal cliff?
Economists will give you a bunch of different numbers on fiscal cliff, but nobody can actually reason with them. They can't rationalize these billions of dollars. Fiscal cliff, basically, you need to know that by coming into 2013, if you own dividend stocks, you cash out, you may have to pay more. That payroll tax deduction that you've been becoming used to, that's going to be waved goodbye. The stock market is worried because they're trying to project future growth. If these stimulus measures are removed from the marketplace, that growth is hurt. And obviously right now, everything gets priced in right now. The market does not like this whatsoever at all.
And it seems politicians here and in Europe keep kicking the can down the road on these fiscal issues. What is can kicking?
Well, I've never kicked a can down the road, maybe a juice box, but in terms of can kicking, it's the prolonging. You just don't want to get anything done as a politician. You're afraid to make tough decisions. You know, we have tough decisions in the country regarding Social Security and Medicare. What you're seeing is politicians put those things off onto the next party because they want to get reelected. And it's just an accomplishment of nothing. You can even see it in corporate America too, where certain problems are not addressed in a timely manner, and they dump it off on the next management team.
Markets are always rushing to parse Fed speak. What is Fed speak?
Fed speak is something created by Alan Greenspan many years ago because he was the king of jargon. Things he said makes no sense to the outside world. Fed speak is basically when you have Federal Reserve members pretty much talking in their spoken language. You don't understand what they're talking about. They're talking in hidden languages. Why they're doing this? They don't want to set off the market. They don't want to spark sell-offs. They don't want to spark massive gains. So they have to be very coded. To the average American, you'll have no idea what these guys are talking about. But people like us on Wall Street, you do start to understand what Fed speak essentially is, and you need to know to place your trades and position your clients accordingly.
All right. Thank you so much, Brian, for breaking it down. We hope to see you soon.
Thank you.